Hello and welcome to Crux Investor. We had a great conversation today with Kerry Knoll. He's the chairman of Generation Mining. If you're into green investing, this could be for you. They've got palladium, platinum, copper, and gold. We talked through how they managed to pick up the project and how they're accelerating through to a 2021 feasibility study delivery. If you want our thoughts on the conversation, the plan, and indeed the company itself, you can find that at cruxinvestor.com/club, where you can also find detailed company reports. You can get commentary from experts from around the world on a variety of companies and commodities. Also training videos to help you with your diligence process, summaries of other interviews that we've done to save you some time. And you can join a thriving community of investors sharing their thoughts and ideas with each other in a nice, safe environment without trolling, abuse, or judgment. Wouldn't that be nice? So go and join them at cruxinvestor.com/club. We'd love your feedback too. So do give us a like, leave your comments below. We'll get back to absolutely everyone. And if you want to see what we talked about today, take a look in the description below. Hey, Kerry, how you doing?
Good, great, thanks.
Well, thanks for coming on the show. First time we've heard the story. First time we've spoken. Looking forward to this one. Palladium's a bit hot at the moment, isn't it?
Yes, it's had a good run.
Had a very good run. So where in the world are you?
I'm in British Columbia, Canada, central British Columbia.
Oh, very good. Whereabouts? I know some of the landmarks. Whereabouts?
Just north of Kelowna, right on Lake Okanagan.
Oh, beautiful. Beautiful. Good wine there. Wine growing.
Yes, we're surrounded by wineries. There's a vineyard borders our property. It's nice.
Good.
The wine here has really improved even in the 5 years that we've been living here.
Yeah, it takes a bit of time, doesn't it? I occasionally have a little bit of Lebanese wine that's 900 years old. So I think you've got a ways to go.
Yes, we were in Lebanon a few years ago. We were surprised to see there was some decent Lebanese wine.
Well, you know the story during the war there, that both sides, they agreed, we do not go into this zone where all the vineyards have been for 900 years. Both sides agreed that there was only certain places that they would actually engage. And so the wine was saved because of the history, I suspect.
They had their priorities.
They definitely did. Well, look, why don't you kick off and give us a 1-minute overview of the business, and then I'll pick it up from there with some questions.
Okay, so Generation Mining is a relatively new company. We were formed in 2018. My partner in the business, Jamie Levy, who's the CEO, and I had a company called Pine Point Mining, which was taken over by Osisko Metals in 2018, and we spun out the exploration properties into Generation Mining. But we really went looking for the next big thing, and we decided then that it was palladium, and we started looking at palladium properties, and finally in 2019 we were able to get the Marathon project in Northern Ontario, which is the largest undeveloped palladium project in North America.
Okay, brilliant. Thanks for that. I mean, definitely hot. Looking at the spot price for palladium, well, and platinum, I guess, and copper and gold. You picked all the right commodities there. So tell me how it came about. Obviously, I know you were looking for it, but given the history, in fact, it might be worth you explaining the history of this as to where the Marathon project first emanated from.
Sure. So I was actually set foot on this property for the first time 35 years ago.
Wow.
I was working on. I was a writer then, and I was working on the big Hemlo gold discovery, which is in Northern Ontario, and it's produced 25 million ounces. It was a terrific discovery. And down the road from it, there was an old copper showing that a junior company started drilling, and and for the first time they assayed for palladium, and they discovered it had some palladium. But of course, palladium in those days was $200 or $300 an ounce, as was gold, also. But nevertheless, it was too low grade. So they kept drilling, and then another company had it, and then another company had it, and finally, by 2010, someone did a feasibility study on it, and it was considered quite promising. And an American company called Stillwater, which is the only palladium company in the United States, or was, they bought it. They paid over $100 million for it in 2010. And they were getting ready to put it into production, and then they decided that the feasibility study needed some work. So they did another feasibility study, which concluded that at then $600 palladium, that this was not a mine. And it's still not a mine at $600 palladium. But so Stillwater put it on the shelf, Stillwater was acquired in 2017 by a company called Sibanye out of South Africa. And Sibanye took all of their development projects that they acquired with Stillwater and kept them on the shelf. They didn't do much work at all to advance them. And so we knocked on their door in late 2018 and said, look, this we think the palladium price is set to rise. And we had our reasons for that. And they agreed with us. They, in their history, Sibanye had never built a mine. So they weren't looking at building this anytime soon. And they sold it to us. They sold it to 80%. Well, a 51% interest initially, and then we've now earned up to 80%.
Okay, and it's interesting actually. Some pretty big names. I mean, Stillwater, weren't too shabby, and Sibanye, pretty big company, and they've got a big track record in palladium generally. So I guess this interested them. What I can't understand is why they didn't move it forward. Did it just not move the needle for them?
I think there was a variety of reasons at the time. Number one, it probably didn't move the needle for them. There are over 3 million ounces of precious metals a year they produce now. They're the largest platinum company in the world. They are, or arguably, they're first or second anyways, and they're one of the largest palladium companies. They are the largest rhodium company in the world. So at the feasibility study level that had been done previously, this was looking around a 200,000 ounce producer. So for them to go into a country where they're not mining, I mean, I this is my speculation. I can't speak for their decision making. But for them to go into a new country, build a mine, they would have to do probably another feasibility study. Then they would have to permit it. Then they would have to build it. At the time when they were a little tight for money, I know they did a financing in the middle of our negotiations for $120 million, I think. And then, of course, things changed for them. The metal prices went way up, and they're in a lot better shape than they were then. But I assume that it A, didn't move the needle for them, and B, they've announced over the years that they want to grow by acquisition. They want to buy producing mines. Their president has said even recently that he's looking for a $3, $4, $5 billion acquisition. So again, this is small for them.
Yeah, it is. That's kind of interesting to me. So you're suggesting that they probably won't take up the option of the additional 31%, which is on the table at the moment.
Okay, yeah, let me explain that. So once we do a feasibility study and announce a production decision, they have the right for 90 days to buy 31% back. And to buy that, they have to put up 31% of the capex, which is a significant amount of money. From our PEA numbers, that's about $130 million. But if you look at the size we're looking at building the mine in the feasibility study, it's significantly larger, and therefore we're talking about probably around $200 million for them to buy back 31%. Well, our market cap is $110 million, and we own 80%. So it would make a lot more sense if they were deciding to build this to buy us. But I can't, again, speak for them. I can't say what they're planning to do. And I don't think that they've even decided or thought about it too much because they want to see the feasibility study.
But I guess what I'm trying to do is discount that as an option in my head, discount it as an option of something which may happen down the line, right? Because you said they want to buy producers. That's what the chairman said.
That's what they said.
Right.
And number one. And number two, if they want to do this, I suspect they're either going to walk away from it because it's not big enough for them, number one, or number two, I think the other option would be there for them to buy us. But I cannot speak for them. So until we see what they do, but they're going to have to make that decision sometime this spring.
Right. So why'd you say that? Is that conditional?
Well, they have 90 days after we make a production decision.
Got it. We're
going to make that decision shortly after the feasibility study is released, and that's about 5 weeks from now.
Okay. Well, okay. That's new news for me. So 5-6 weeks from now, feasibility comes out. You'll be making some kind of decision. Okay. So do you have the option to buy them back out?
No.
Why?
We have a right of first offer, but it's no. We don't have the right to just buy them out. So they may opt to participate with their 20%.
But that doesn't seem to fit the pattern of what's been stated, as you said.
No.
Right.
No.
Okay, interesting. So at some point there may be a conversation. Maybe.
Lots of conversation.
Okay, right. Okay, so well, I read somewhere that actually there'd been 3 feasibility studies done by Stillwater. So was that on across different properties, or we talking specifically Marathon?
All on the Marathon main deposit. So the first 2 were actually done by a company called Marathon PGM in 2008, and then they redid it in 2010 when prices were a little bit better. They did it, the first one, just before the crash in 2008. And then when things were looking pretty rosy in 2010, they updated it because they had done a lot more drilling and made it actually larger. And then they got taken over. And then in 2014 is when Stillwater did their 1 study, which was never released and has to this day has never been released. I mean, we have it, but it was never put out to the public.
Right. And hence again, just asked, there's a lot of questions sent in. So hence you decided to go back and do a PEA because there's a bit more data, a report which hadn't been released, and you felt it was better to kind of step back and get a firmer understanding for you guys.
So there was some question in 2014 when Stillwater had it about the resource being valid or not. We don't really understand that. So we decided when we got the property to go back to the original drill results and start all over and redo the resource. And our numbers came in very close to the original ones. So the resource was valid. That was number 1. Number 2, we decided to do a PEA because we wanted to figure out a couple of things. One is can we build this smaller? Because they were looking at 9 million tons a year. We thought, well, we're a junior company. We would like to, does it work at 5 million tons a year? And it did. It worked beautifully. But we were hearing loud and clear from some of our investors that we wanted to keep the capex down to a manageable level. But that was still when palladium had a 2-year trailing average price of $12.75 an ounce. Well, palladium is, as you know, well over $2,000 an ounce, and therefore a larger capex doesn't look quite as scary today as it did a year ago. So we decided to look at. For our feasibility study, we went back and looked at all the different sizes and what size what is the best economic return? And it turns out that's closer to 9 million tons a year. So we haven't finalized the number yet. We're in the process of doing a few more trade-off studies, but we're very close to it. And it is going to be significantly more than the 5 million tons a year. And just so people know, if they're looking at tons per day, 5 million tons a year is 14,000 tons a day, and 9 million tons is about 25,000 tons a day. So that's what we're looking at. Okay.
When you've done that feasibility study, what do you do next? Do you follow convention and you go, let's get a bankable feasibility study done? Or you think at that point, we've got enough to actually go and have conversations about seeing who will finance this, how this thing gets financed at even 9 million tons?
So this is a bankable feasibility study that we're doing.
Right. Sorry.
Technically, because of the mining regulations in Canada, we're not allowed to use that word bankable, even though some people do, because there's no technical definition of what a bankable study is. But this is a bankable study. It's done by, the lead on it is a company called G Mining, who is famous. They built Osisko's Malartic mine. They built Lundin Gold's Fruta del Norte mine. They've built big mines, open pit mines all over the world. So, and we decided to go with them because they're regarded as one of the best. And also Drew, our chief operating officer, had a good relationship with them, having worked with them on the expansion of Detour Lake a few years back when he was a senior executive at Detour Gold.
Right. So what's making this? Obviously, metal prices have increased, and certainly all the ones that you were talking about have increased. But what are the other components here? You mentioned open pittable there. I mean, that's obviously going to save a little bit of money too. But how meaningful is it when it comes to what you're doing?
Well, open pit is important for a couple of reasons, but the main one being time. If you look at time in being money, the underground projects, Platreef Friedland's company has a beautiful deposit in South Africa, and they've been trying to get at it for 5 years, shaft sinking. They haven't really announced even when they're going into production yet. It's just a long timeline. Platinum Group Metals, another company with a great deposit in South Africa. they're talking about 6 or 7 years once they start to getting into full production. Well, we can get into production in less than 2 years after we start construction, as little as 18 months. And that's the benefit of having an open pit, because the material is right on surface. It comes to surface. So we believe that we will be in full production in this cycle, and I don't believe there's another palladium mine anywhere in the world that can say that.
Yeah.
So you asked what is next after the feasibility study. So there's two main components. The number one being permitting. So let me talk a little bit about permitting. Fortunately for us, the previous owner, Stillwater, did 2 years and spent a lot of money permitting. They did all the studies, they did a lot of work, and that's all money in the bank that we don't have to redo. We have to update it. And so we're taking their 32,000 pages of files and updating them. And we're almost finished that process. We're going to be finished that hopefully by the end of February. And at that point, we submit to the government. And there's many different permitting methods in Canada. It's quite a complicated business here. We're in something called a joint panel review, which is a review of an independent panel appointed by the federal government and the provincial government, called joint panel review. And they have 271 days to review this document once we get it. And at that point, they make a recommendation to the two ministers, federally and provincially, and say whether this project should go ahead or not. And they look at everything from, the environment to community relations to the benefits to the world of this product. They look at everything, right, and make a recommendation.
Okay, so that's all the, when you say local community, you're talking about the First Nations, local towns.
First Nations and the local towns.
Okay, fine. So that's environmental wrapped into one. I just wanted to, I didn't mean to before we go on too far, is with regards to when you've got kind of polymetallics, the metallurgy becomes really, really important to understand. So, what's been done to date, what more has got to be done in terms of optimizing recoveries from the open pit? Okay, so there has been a tremendous amount of metallurgy work done on this project, but as you clearly know, it's almost never totally done. And so when we reviewed this, we used the metallurgy from the previous feasibility study in our PEA a year ago, but then we brought on a fellow by the name of Steve Haggerty, and Steve was a metallurgist, and he was vice president of operational support for many years at Barrick. So, worldwide experience and a terrific metallurgist. And he reviewed everything, and he thought, this metallurgy that you have in there is going to be a really difficult mill to operate, because they're grinding the material so fine, it's gonna cause some problems. So is there a way around this? Is there anything else we can do? So we looked at all sorts of things. Steve came back with two big recommendations right from the get-go. One was that we look at the reagent selection. Reagents are something that chemicals that you put in with the ground up ore to make it float, the minerals float better. And he went to the companies that make these and researched these and supply these, and found that they have improved them since the last feasibility study. And so we tried some of the different chemicals, and lo and behold, they work better. The other thing he looked at was introducing something called a flotation reactor, which is it's just flotation is the main way you get metals out of ore other than gold. So flotation is a technology that's been around for well over 100 years, and it hardly changed. Other than reagents changing, it hardly changed in 100 years, until these guys, Canadians, came along in about 2010 and started experimenting with new ways to do it, and came up with this flotation reactor, which we are introducing to our project. Now, it's not brand new technology. It's being used by Vale, it's being used by BHP, it's being used by Freeport. It's in 200 mines now all over the world. It's been around commercially for about 7 or 8 years now, and we have the advantage. And a lot of mines are actually now replacing their old flotation with this new stuff, because you get better recoveries and it uses less energy. So there's a number of benefits from it. So we did those two trade-offs. We discovered that we can go with a much larger grind size.
So A, that saves us money milling, and B, it's easier to handle, and C, we're able to get better recoveries by using this new technology. So our recoveries have gone from 83% on palladium to about 87%, and up to now to 93% on copper.
Right. So because you guys have to optimize it for whichever commodity is going to give you the biggest return. So you've got choices to make there. Obviously, the focus right now, palladium totally makes sense. Copper makes sense because you've got a lot of it. Because the gold component is relatively insignificant,
right.
But as a byproduct, and to a degree, so is platinum. So you've got to. There's a process of working out the economics, and as the market changes, are you able to adapt and change, or is once the flow sheet's been agreed, that's how it works?
No, that's going to be how it works. But the thing is originally they were looking at this as a copper project with a palladium credit. We're looking at it as a palladium project with a copper credit, and as well as the other metals. So no, the flow sheet won't change. But what will change, and what's interesting, is the way that we've scheduled the mine. The southern part of the main deposit, which is called the W Horizon, has got higher grade palladium and lower grade copper. So we think that the price of the metal, palladium, is going to be strong for several years. But at some point, as electric cars get more popular, it will start to fade. But then you're going to need a lot more copper. So we're focusing on starting with the high-grade palladium, and through the mine life, going to the high-grade copper at the end of the mine life.
That's where I was getting to, because you got to adapt to the market, right?
Yes. Not every ore body lets you do that, but this one does.
Interesting. Are there any other kind of little other things that you've been looking at just in terms of optimizing what you've got? Because it's quite a big land package, right? You've kind of got various sites that you could tackle in any particular order you want.
Well, we have 3 known deposits on the property, and we're only focusing on one of them right now because the other 2 are smaller and had no permitting work. So had we wanted to include those in the feasibility study, it would have been delayed at probably a year to 2 years. So we decided not to do that because we've got a pretty good mine life with the main deposit. That said, we continue to explore, and the main reason we're continuing to explore is that this deposit in our PEA is a 1.24 grams palladium equivalent per ton, which is favorable compared to a lot of these open pit gold deposits, which can be as low as 0.08 grams or 0.09 grams. We're a little higher grade, but still we're on the low end of the grades in terms of worldwide. So we are looking for high grade. So we continue to drill. We will, if we can get a drill this summer or this winter, we're going to be drilling, and we're certainly going to be drilling some more this summer. There was a rock found on this property a few years ago that graded almost 200 grams palladium per ton, as well as 9% copper. And it came from somewhere. And we don't know where it came from, but we're looking. Because if you can find a small, even if it's a small, very rich underground ore body to supplement the lower grade open pit, you're gonna do even better. And so we're looking. We haven't found it yet. We have found some pretty decent underground grades, certainly grades that are comparable to the only other palladium mine in Canada, which is Lac des Îles, which runs around 2.3 grams underground mining. We've been getting some grades as high as 5 and 6 grams palladium equivalent underground. So, but those are not going to be part of the feasibility study. Those are for the future.
Right. So how does this thing get financed? Because as you've already stated, the market's changing somewhat. Obviously, EV revolution. It's driving at the commodities for battery. The lithiums, the coppers, the nickels of this world. But there's also a thematic for cleaner, greener investing generally. So are you finding people are coming to you? Because
yes.
Because the strange thing is you've got some pretty big numbers now. The copper number, huge, over £1 billion. Palladium number is big, but you're a 100 million market cap company. What are people missing?
Well, I don't know 100%, but one of the things I suspect is that we don't have a feasibility study yet, and I think that people want to see that validated. That's probably number one. Number two is, yes, they're probably questioning whether we have the ability to build it. And we will have our work cut out for us on financing, but we also think we're capable of it. So there's so many different ways to finance mines these days. We're talking with, for example, a smelter, international smelting company that is talking about possibly loaning us 60% of the money to build this mine. We're talking with streaming companies, and they have been, a couple of them have been fairly aggressive talking to us, and there's no royalty on this deposit. So streaming is a very, very positive way of financing. And we're looking at possibly streaming the gold and the platinum and keeping the copper and the palladium for ourselves. Those are some different options. So we could add a big component. So there's debt, there's streaming, there's obviously equity, and there's also partners. We are talking with some potential partners. That's not our preferred route, but that is also an option that could be on the table. And there's some private equity companies that have kept in touch with us throughout this whole process. So we have a lot of different options. And then, of course, we may be acquired. That's not our preference. Our preference is to build this because we think it'll be worth a lot more money for our shareholders built. The only other palladium mine in Canada was called Lac des Îles, and it was acquired by Impala for $1 billion, Canadian dollars, in 2000 and I'm saying 18 or 19. It was acquired. It's about 200,000 ounces a year. It had a 7-year mine life left, and palladium was at $1,500 an ounce when they acquired it. So that had to be 2019. So if that was worth $1 billion at $1,500 palladium, I think built mine by us, larger, much longer mine life, state-of-the-art equipment, would be worth probably $2 billion to the market. So if we can build this, our shareholders are going to do very well. So that's our preference. But again, I can't say someone might make a bid for us along the way. And I can certainly see that a gold mining company would be interested in greening up their product line by adding, and these are precious metals, but by adding the greener precious metals to their suite of, and then of course the other potential, another obvious potential is of course the South African mining companies that want to diversify internationally to safer jurisdictions. And where they can.
Yeah, I mean, I know that they're big on the palladium and platinum down there, and they've got the experience to build mines too. Yes. Who on your team has got the experience to build this out?
Well, I've started 6 companies in my career from scratch. 4 of those got to production. The other 2 got sold before at the feasibility stage. So I've been through it before, not as the operator, but as the financier. Drew Anwell, our chief operating officer. So he was one of the key guys when they built the Detour gold mine in Ontario. Previous to that, he was the mine manager at Porgera for Barrick in Papua New Guinea. And previous to that, he was at a company called Placer Dome, which was acquired by Barrick. And for them, he did several startup mines. So he's probably built a half a dozen mines in his career. So he's our chief operating officer. And so between the 2 of us, and we've got 2 directors also who have hands-on experience building mines. So they serve in an advisory role to us. One of those is Cashel Meager. He's the chief operating officer at Hudbay. The other one is on the accounting side is Paul Murphy, who's the chairman of Alamos Gold. Okay,
so you definitely don't feel you need a partner to come on board to help you build this thing. You've got the team to do it. That's what you're saying.
We think we have the start of the team to build it. Obviously, we would have to flesh that team out in order to, if we're going to be building it ourselves. So we have on the timeline, we expect our goal is to get our permits about a year from now. So we've been at it. We think that we can get it a year from now. So that gives us that year to do 2 things. One is to arrange the financing. The second one is to do the detailed engineering, which you need to have in order to start building. And if that takes 6 or 7 months. So we don't want to wait on that until we have our permits. We want to start that this year as well. And We have about $13 million in the bank. So we will need a little bit more to build it, although we have about $4 million in warrants coming that are well in the money coming up in July. So we're very close to having enough money. We think we need to get all the way through to permitting and final engineering. We need about $20 million. So we're very close to that now with the warrants that'll be coming in, and we would have to do another small financing. We may do a larger financing, but not right now. We're going to wait and see what the fallout from the feasibility study is, because we think it's going to be very positive.
Okay. I mean, again, I'm just trying to come back to what are people missing? 100 million market cap. Do they think that you are overstating the time frame here? Because you've been at this since late 2018. I mean, it's unusual to get a feasibility study done in 2 years. I mean, or 3 years. Wow. We only acquired this project. We only got possession in July of 19. So we only had it for 18 months. Yes. Okay. It turns the heat up on that question even more. So do you think people are thinking, well, there's no way they can, in 18 months plus 1 year, deliver a feasibility, definitive feasibility study?
We'll show them that we are, and we're using some of the best firms on in the business. Between G Mining, Asenco is doing our plant for us. They're well known. Knight Peacehold is doing all of our tailings, and those are the big three areas: the mine, the mill, and the tailings. And we've got some of the top firms in the world doing them for us. So, and they're not cutting any corners. And our instructions to them was, we want to know how much this is going to cost. We don't want like a best case scenario here. We want to know what the real cost is going to be.
Interesting. Well, I appreciate your time today, Kerry. Like I said, news story. You seem to have done a lot very quickly. A few more deliverables to go, but once you get those over the line, I think people will start paying attention here.
Yeah, well, a typical company at our stage of development trades somewhere between 30 and 50% of their net present value discounted. We're trading at less than 10. So we think that we will be re-rated. If you look at the famous Lassonde curve, we're kind of in that trough that shows up around the feasibility study time. So we're going to have that if people believe that we can get our permitting and our financing together. And I mean, I've raised money before. I've probably raised $1.5 billion in my career. The companies that I founded, one company in particular, Thompson Creek, we raised $700 million in 2006. So I can raise this money. There's no question. And there's way more options for raising money today than there were back then. In those days, it was debt and equity. That's all you had. Now you have streaming and private equity, and you have offtake partners, and countries actually, they know that they need palladium in order to continue to build cars. People don't really turn that to mind, how important it is. But it's one of the few metals that you cannot build a car without today.
Appreciate your time, Kerry. Stay in touch. Let us know how you're getting on. I'm excited to hear what's coming up in 2021.
Well, I appreciate your questions. They were good.